and welcome to a brand new episode of Smart Money. On today's episode of Smart Money, we have with us Radhika Gupta, the MD and CEO of Edelweiss Mutual Fund. Now, although she needs no introduction, I want to give her one because she's someone who's not just the CEO of Edelweiss Mutual Fund and the only female head of a large fund house, but she's also someone who set up India's first domestic hedge fund, a famous public speaker and trailblazer. But my favorite is this: she's authored a book, Limitless, which is a complete guide to overcoming your adversities in life, achieving all your goals, learning from your failures, and celebrating both your perfections and imperfections with ease. So Radhika, thanks a lot for joining us on the show today. Radhika will be answering all of your mutual fund queries in the next half an hour. Of course, we'll talk about mutual funds, about the markets. But Radhika, welcome to the show. You know, when we promote this show, we got inundated with queries on mutual funds. But before I start with that, I just finished reading your book, and it is a raw, honest documentation of your struggles, your successes, and how you went on to lead one of the fastest growing fund houses. So, you know, before we begin the show, Radhika, if you had to pick one big learning or takeaway from the book, what would it be?
My favorite one, which is the one at the very end, and it's also something I heard Dr. Jaishankar echo in the context of India, which is be confident in who you are and deal with the world as you are rather than being an imitation of someone else. So I think ultimately it is a journey of finding self-confidence through rejections, through struggle, through anxiety, through tough times. But it's, life is a journey of finding yourself. So I think self-confidence is by far my favorite theme.
Okay, self-confidence is your favorite theme, and you have a lot of little gems through the course of the book, right, which I'm going to revisit later on. But as I said, this show is special because it is for our viewers, where we've put together a whole lot of queries, and we're going to sort of ask you your views on them. So let's get straight to that. First up, we have Akash Dhanuka, who's written to us. He asks us, would it be prudent to invest in debt mutual funds, as the returns, he says, has been pathetic over the last 15 months. So perhaps a jilted investor here. Your views on this, Radhika?
So I have a two-part view. One is, I think, yes, debt is an important part of your portfolio. The quantum is something that you should decide, but any portfolio needs to have wealth creation instruments, which are equity, but also instruments that give you protection in volatile times. And we have seen volatile times. So debt is an essential part of your portfolio. Mm-hmm. The second point I would make to the investor, because obviously he's disappointed in the last 15 months, is that debt is not the place to get greedy. There are periods when interest rates are 8 to 9%. There are periods when interest rates are 3-4%. The biggest mistake you can make with debt investing is trying to, optimize for that 1-2% of extra yield and do things that you don't understand. So have realistic and limited expectations with debt and build a simple debt portfolio of contingency money and maybe some long-term debt money.
Okay, so don't expect your debt portfolio to sort of outperform, because it's just, I guess equities is the place to go where you want to outperform. So keep it simple as far as debt is concerned. Got that. Milap Sharma has written to us. Thanks, Milap, for writing in. He wants to know which is better between actively managed funds and smart beta funds. Your view, Radhika?
Okay, so I get this question, many, many times. And I think you have to realize both funds take some element of risk. So on the spectrum, there are essentially three kinds of funds. There are pure play passive funds, which are following a rule and invest in something like a nifty passive fund or a large and mid-cap passive fund, not a mid-cap fund. They're just following a rule and investing in a set of 100 or 250 companies. On the other hand, you have actively managed funds where the fund manager is taking that universe of 100 or 250 companies and picking stocks. Somewhere in the middle, you have what is globally called as smart beta funds, but essentially they're also following a rule. That rule could be investing in all companies that are momentum driven or all companies that are value driven. One myth I do want to address is that all three of these categories of funds have risk. So whether you're investing in a nifty fund, whether you're investing in a value fund, or whether you invest a value smart beta fund, or whether you're investing in an actively managed fund, you are taking market risk. And it's very important to understand that, because I see a lot of these comments that index funds, smart beta funds don't have risk. Smart beta funds, in my view, are a tactical tactical addition to your portfolio. Your core portfolio will always be mainline themes. It'll either be mainline active themes like flexi cap or large and mid cap, etc., or mainline passive funds like Nifty or large and mid cap. Smart beta funds tend to cover select themes. They could be value, momentum, as I said, and they can form a satellite part of your portfolio, the satellite 20%. It's rare for them to be the core. And if you're getting into a smart beta fund, please understand what the strategy is, when it will perform and when it will not.
Okay, so smart beta fund shouldn't be a part of your core portfolio. At best, a part of your satellite portfolio. That's about 15 to 20%. Now, the next question is interesting, Radhika. You know, it comes in from Abhijit Tandon, and I must tell you that many people asked us this question, so I thought I should put it in front of you. He recently invested in the Edelweiss IPO fund and wants to know, is it good for long term? Now, I know where this is coming from because all the recent IPOs have been extremely disappointing, whether it's Paytm, Zomato, Nykaa, and the Edelweiss IPO fund itself has not done that well. Purely for that reason. What does one do here?
Okay, so I just want to put this into context. One is I'm glad the individual mentioned long term because recently listed IPO fund is something that is looking at newly listed companies and they will take time to deliver. So and in the pitch, we've always said, don't be obsessed with listing day gains because we aren't. We are really obsessed with finding new economy companies that will deliver over the long term, and that is truly 5-7 years. I would agree. I think the last 6 months have been very volatile for recently listed companies. And that's not just in India, but world over. But I think the track record of this fund is outstanding over 4 years, even over 1 year, actually, substantially beating the benchmark. So we're very confident that this is a great long-term proposition. And two things I would add about this fund that are less known. One reason to have this fund, and this is a satellite fund, I have to be fair, it's a satellite fund in your portfolio, is it does not have significant overlap with your traditional core portfolio because new economy companies are traditionally not represented in those. They're at max 7 to 10%. We did that math. Secondly, while a lot of the IPOs we named have not done well, this fund is very, very selective. So in the last year, there were probably, I think, 60 to 70 IPOs that came to market. This fund probably did not participate in more than 20. And that's exactly the reason to have this, that leave the selection to us rather than doing it yourself. But yes, the fund needs time and patience.
Okay, the fund needs time and patience and keep it as a satellite fund, not in your core portfolio. Kaushal Kelkar has written in to us, he asks us, what are the must-have mutual funds in one's portfolio? Now, this show gets a lot of young viewers who have perhaps just started their investment journey. So I get asked this question a lot. If I'm between 20 and 30 years old and I want to create a mutual fund portfolio, what all should exist in it? What's your mantra here?
Okay, so one is, I think, for any investor, young or old, have a limited number of funds. Your core portfolio probably should not have more than 5 to 6 categories of funds. And I know there are 40 categories of mutual funds out there, and that really confuses people. But the core categories, probably 3 equity categories and 2 fixed income categories. And I'll just name those shortly. And maybe 2 funds in each category. I think a good mutual fund portfolio can be built in about 10 schemes, and then you can do tactical stuff. So I just wanted to put that out there. On the equity side, I think there are 3 kinds of funds that are sort of the mainstay. What I always say are the dal rice of equity investing. One is having either a good flexi cap fund or a large and mid cap fund that gives you broad market coverage, which all of us need. And it's a little better than large cap because you have upside. The second is a good mid or small cap fund, one of the 2 categories that gives you upside. And the third, and this is especially true for moderate investors or conservative investors, I consider myself one, is a good quality hybrid fund. So the balanced advantage category tends to be my personal favorite in this category. But I think between these 3 equity funds, you really have everything covered. And then on the fixed income side, you need to park cash in a liquid or short-term kind of fund. And then if you're looking to park debt money for the long term, you can have some long-term debt index funds. And that's it, 5 categories right there.
All right, got that. So folks, Radhika has very beautifully laid out an investment plan for you, the do's and don'ts if you want to start your investment career, or rather if you want, you start your investment journey. Now, Samrat Datta has written to us. He asks us, do index funds beat equity fund returns over longer term. Now, this is a debate that has been ongoing for years, right? People believe that passive funds have beaten active funds for years, so it's better perhaps to invest in index funds. Your view here?
Okay, so I think, and I run a business that is 50% active and 50% passive. So even though my industry is often accused of not liking passive management, I think I can talk with a little lack of bias here. I don't think the question to use index funds should be whether active beats passive, because frankly, it is hard to tell. In a market like the US, which is more developed, perhaps you have more data and more history to have these answers. Honestly, in India, especially in categories like mid cap, etc., you don't have that. There are years when in large caps or mid caps, active funds beat passive funds when the rally in the market is a lot more broad based. Typically, we see in downside times, active funds tend to beat passive funds. And there are also periods, openly saying it, where the rally is a lot more concentrated and passive funds outperform. There is no way to predict. And there are good active funds out there, and there are active funds that don't beat the benchmark. Keep in mind, passive funds will give you market returns minus fees. Active funds will be up or down. The reason to do passive funds, honestly, in your portfolio is one of simplicity. The reason to do them is not this will active beat passive, etc., because that's a prediction on the market that no one can make. So you can, and you don't have to do. The question is not or, it's and. You can build a portfolio that perhaps has a large cap passive fund to give you broad-based market exposure, or a large and mid-cap index fund, and supplement it with a nice mid-cap and small-cap active fund, which is typically an alpha-creating category. So who says you have to choose?
Absolutely. So, the next question is the obvious one that comes in from Nitish Goel. Since passive investing has picked up quite a bit lately, he asks us, what would you suggest as some good index funds if one wants to get into them now? Your views?
So I think two sides to, there are three categories of index funds: equity, fixed income, and gold. On the equity side, I think broad-based market exposure is really nice. So Nifty 100 funds, for instance, we have a large and mid-cap passive fund, index fund that just gives you exposure to the top 250 companies in India. So my bias is always towards things that are extremely simple to understand. So finding an equity passive funds that give you exposure to the top 100 or top 200, 250 companies, I think that's a great way to start. I often joke, Sonia, I'm going to have a kid soon, that if I have a kid, then one of the first SIPs I'll start is a large and mid-cap index fund. It's just a simple thing to do. On the fixed income side, I think there is a great category emerging of debt index funds. They're called target maturity funds, started with Bharat Bond, but now, of course, there's a much wider basket. And they are like quasi-FD in nature in the way they work. You choose your maturity, so whether it's 2025, 2026, 2027, align your goals to that, and they typically hold either PSU or SDL paper. So those tend to be great ways to get FD-like experience with debt mutual fund taxation. And then, of course, on the commodity side, I think gold index funds are out there.
Okay, first of all, congratulations on your child to come. It's a very, very special time, and I must tell you, your life changes in every possible way. It's exhilarating and exhausting at the same time. I can't explain it, but you will know in due course. But you know what? We get so many messages and so many questions. People want to invest for their children. So just a follow up here. You said invest in a passive fund, perhaps an index fund. Is that the way to go for a newborn or for a little child, or do you also, because there is the power of compounding, so do you also go really aggressive, perhaps invest in a small cap or a mid cap active fund as well?
Look, it's very individual, but I think there are two things you can do. You should build an equity portfolio because you have time on your side, as you very correctly said. Now, how you build that equity portfolio is personal choice, but a nice index fund, as I was just discussing, something like that, a little bit of mid cap and small cap exposure. I think these two combined give you a good domestic equity portfolio. One other interesting idea I also have from a child's point of view is that something that we all will be thinking about is child's education and eventually child's education overseas. Now, I've studied abroad, and I'll tell you the dollar cost of studying abroad since 15 years ago when I went to Wharton has doubled, and the currency has, depreciated. I think it's gone from 40 to 75. So you also might want to look at some international fund exposure in your child's name. Start an SIP, there. And eventually, when the child wants to go abroad for education, that's also a hedge against potential inflation in education cost and the currency.
Okay, that's a fair point there. All right, let's do one thing. Let's slip into a short break. We've gone on for a goodish bit with all of your queries. Don't go anywhere. When we come back, we're going to do a fireside chat with Radhika about her latest book, Limitless, and the key takeaways. This is one segment you don't want to miss. Stay tuned. Welcome back to Smart Money on CNBC TV 18. Now, before the break, we were chatting with Radhika Gupta, the MD and CEO of Edelweiss Mutual Fund, about all of your queries. But now I want to focus a little bit on her latest book, Limitless. If there's one book you need to read this weekend, it's Limitless, because it not only talks about her journey to success, but it also helps you become the best version of yourself. Radhika, there are so many things about this book that I absolutely love. But what really stayed with me is, a page in which you talk about the league tables that the world throws at you, which are limitless. But there's only one league table that stays with you in your head, right? I mean, it is your own and you need to focus on that. But tell us, from a career or a market standpoint for that matter, how does one overcome adversity? Because there are so many periods, even in the market, you get frustrated, you don't really end up making money. How do you overcome that?
Yeah, in fact, I think the interesting thing is a lot of people are telling me my book has a lot of markets examples. And I think markets teach you a lot about careers and life. And I think one of the things we have to realize in both careers and markets is the fact that you will have extraordinary runs and you will have terrible runs. You will have runs where you don't make money, where equities don't make money, where the world is volatile. All of that happens. And so much about it is just being resilient and staying through. One of the biggest mistakes we make, I think, in both investing and careers, and it's becoming increasingly common in both, is giving up too early. So, I always say don't stop your SIP too early. Don't give up on a job you don't like too early. Because you just never know when the turnaround is coming. So I think that is extremely important. The other thing that I think is super important in personal finance and careers both is comparison. And I do talk about comparison, a lot in Limitless, because I think we're all creatures of comparison. I mean, from the early days when you hear about Sharma ji ka beta in your neighborhood, to the fact that we all compare portfolios on Twitter or whatever it may be, I think you have to realize that goals are very individual. Career goals, life goals are very individual. And even in personal finance, by the way, goals are very individual. I mean, no one's running a horse race, even in personal finance. You're doing what is right for you. And so it's important to do what is right for you and limit the amount of benchmarking that you do to other people. We had a conversation, Sonia, on passive funds on this show earlier. And I always say that in careers, you deliver real alpha over the benchmark by finally running away from the benchmark and taking risks. So it's important to stop the comparison, go out and take a little risk because you don't want your career to be a passive fund. There you definitely want to deliver some alpha.
But there are two things here, right, Radhika? I mean, one is, of course, taking risks, getting out of your comfort zone. The other thing is consistency and doing the same thing over and over again, because of which you become successful. But those two are poles apart. So which one do you pick?
And I think it is a blend. I think, you can take, risk-taking sounds very glamorous, both in investing and markets. But ultimately, I think both investing and careers are about taking sensible, calibrated risks, are about knowing how much you can lose. I mean, I remember starting a business, but always knowing that there is an option D in hand. So I think risk-taking is about taking that. And once you've decided to go down a path, you have to stick to it. And you do get benefit of compounding. You genuinely do get benefit of compounding. I think when we hear stories of great companies, we hear how they've stuck to the same thing stuck to it during tough regimes when people may question them. And finally, the market will recognize them for what they are. And I think that's absolutely true of careers. So you have to pick a path, unconventional as it may be, and then stick to it.
Okay, well, we just have a couple of minutes left. I must say that we're really proud of your journey, how far you've come, and all the best for the years to come. But if you had to, I'm sure 15-year-old Radhika or 18-year-old Radhika will be extremely proud of you right now. But if you had to go back and give one piece of advice to your 15-year-old self, what would it be?
I think, that's an interesting 15-year-old. A 15-year-old person.
Well, that's an impressionable age, when you sort of take decisions in your life.
Oh, don't compare yourself to others. Seriously, don't compare yourself, because that's the age when, in this Facebook and Instagram driven world, you're so driven by comparison. Don't compare yourselves to others, and remember that, over the next 10, 15 years, collect experiences. I think, that age and your 20s are an amazing time to collect, learn. Whether you're an investor or whether you're an individual, they're a great time to go out there and collect experiences, and life finally will work itself out.
Okay, when someone, who's 24 years old just messaged me this morning telling me about a new job that she got and the investment that she wants to make. I hope she's watching us right now, because I told her start small, invest steadily, and 10, 15 years hence is when you'll actually reap the big benefits of that investment. Radhika, thanks a lot for joining us. It was a pleasure speaking to you, and all the best for the years to come.
Thanks, Sonia.
Okay, with that, it is curtains down on another edition of Smart Money. Keep writing to us. We'll be back again, same time, same place next week. Till then, stay safe.